I'd like to welcome everyone to this multi-location, that is hybrid meeting of the Pensions Committee, which is open to the press and the public on request. This meeting will not be broadcast live, however, a recording will be made available as soon as possible after the meeting has concluded. Please be aware that this meeting is being transcribed only for the purpose of producing the minutes. This transcript will be deleted once the committee approves the minutes. The transcript should not be downloaded by anyone other than Democratic Services. We welcome the use of the Welsh language at meetings. I've had no request for people to speak Welsh today, so this meeting will be conducted in English only. May I remind members that as per statutory guidance made under Section 4 of the Local Government (Wales Measure of 2011 and our formally adopted hybrid meeting policy, any member attending a meeting remotely must be able to be seen and heard by the members and officers who are attending the meeting, as well as by members of the public viewing the meeting. So can I ask that you all please use your cameras for the duration of the meeting. Please can members attending via Microsoft Teams refrain from using the chat function and instead use the raised hand icon to indicate when you would like to speak. Please remember to keep your microphone muted when you are not talking. So, moving on to the agenda. Item number 1 is attendance and apologies. Jade.
Thanks, Chair. We've not had any apologies this morning.
Excellent, thank you very much. Item number 2, declarations of interest, also Jade.
Thank you. So, starting with Councillor Best, can I just confirm that there are no interests?
Yeah, that's right.
Perfect, thank you. Councillor Hawler, I have that you're a contributor to the fund.
That's correct, yes.
Thank you. Councillor Williams, I have that yourself and your wife are both in receipt for pension and contributors.
Correct.
Perfect, thank you. And then yourself, Chair, I have that your father and 2 other family members are in receipt of a pension and you're a contributor.
That is correct.
Perfect, thank you very much.
Thank you, Jade. Item number 3, minutes of the Special Pensions Committee on the 23rd of February 2026. For members to raise any issues and then to agree the minutes. This starts on page 3 of the combined pack. Do any members have any issues or matters arising from the minutes? John? No. In which case, members, are we happy to pass that? Fantastic, thank you very much. That's carried. Item number 4 are the minutes of the normal Pensions Committee meeting on the 30th of March 2026, which start on page 7 of the combined pack. Again, this is for members to raise any questions. Any points of clarification? John, you okay? In which case, everyone happy to agree those minutes? These minutes are also agreed. Before I move on to agenda item number 5, just I think a couple of housekeeping notes from me. The first is to say that we're currently down to 5 members on the committee. So that's the 4 Labour members present, plus Councillor Tew from the Independent Group. Councillor Keats was not reappointed to the committee at the AGM. I have double-checked this morning. It's not because they're withdrawing from the deliberations of the committee, but we are currently there's currently one vacancy on the council, because Jason O'Connell, who is one of the Reform councillors in Llantarnam, was elected to the Senedd as a member in Merthyr Tydfil and somewhere in May, so he's had to stand down immediately, which is part of the new regulations of the Senedd enlargement. So there's a by-election pending. So essentially, because of that, the Reform Group has gone down to 3 members and therefore under the proportionality threshold. So we're currently carrying a vacancy, and we'll hopefully be in a position to have the 6th member of the committee appointed to the committee in time for the next meeting, which could be Stuart, it could be a Labour member, or any other member, depending on who wins that by-election, which is pending on the 2nd of July. Second is just to say, obviously, to welcome Joanne to the hot seat for this meeting, and then also to Lewis to the other hot seat. As ever, he wanted to sit right in the middle of the table, and we had to tell him he had to move down a bit, because he might have had a promotion, but he's not been promoted that much. But it's just to say, so well done to Joanne and to Lewis and the rest of the team for their work in stepping up and acting up into the positions since Alex's departure. And good luck for the meeting today. And then finally, and so I will hand over to Joe to give us the full details, we are joined online today by an observer. Joanne, would you like to tell people who that is?
Thank you, Nathan. Yes, it's John Balcode.
from With Intelligence, which is part of S&P Global.
So welcome, greetings. I hope you find the meeting of interest. Item number 5, minutes of the local pension board meeting on the 28th of April 2026. This is for members to raise any issues and to agree them. Not to agree the minutes, we're just noting them. This is page 27 of the pack. Ian, as you're here, is there anything you'd like to talk us through?
Nothing to add to the minutes, Chair. Thank you.
In which case, members, we're happy to note the minutes as presented. Thank you very much. I meant to give my housekeeping notes after that one, I think. But agenda item number 6, the first substantive item on the agenda, audit inquiries of management. This is over to Joanne. This is page 45 of the combined pack. Joanne.
Thank you, Chair. So the purpose of this report is to explain the purpose of the inquiries of management document produced by Audit Wales and request that Pensions Committee approve the responses provided below. So Audit Wales is the body responsible for conducting an annual external audit of the pension fund annual report and accounts, and they produced their audit plan, which was presented to Pensions Committee in March. This sets out how Audit Wales intend to conduct the audit work for the forthcoming year. Every year, as part of the annual accounts and audit process, Audit Wales requests responses to a comprehensive inquiries of management questionnaire from those charged with governance, including senior officers and the Pensions Committee. And a copy of the fund's draft responses has been prepared and is available under Appendix 1 of these papers. The purpose of the inquiries of management is to demonstrate how management and the Pensions Committee address key areas of audit focus, including financial reporting, risk and compliance with laws and regulations. The response explains the fund's processes for risk assessment and also outlines how the committee oversees these areas to ensure transparency and accountability. The same letter was taken to Pensions Committee in October last year, and it remains very much the same as the one that was approved last year, with only minimal changes that have been made, updating dates and information around the valuation. Due to this, I wasn't planning to go through it in great detail, but if members do have any questions about it, then I'm more than happy to answer any questions. So yes, if I could just ask Pensions Committee to approve the responses if they are happy with them.
Okay, thank you very much, Joanne. But as Joanne said, we have gone through this fairly recently. So when I was going through it yesterday, there was nothing that jumped out at me. But obviously there is an opportunity for members, if they have any questions, or if any of the advisors and indeed board members in the room, if there's any queries you have, I'm more than happy to take them. No? All clear from David, Alfie, John? Anybody else? Any questions you'd like to raise? In which case, this could be like, I'm not going to jinx it, this could be a speedy meeting. Page 46 then, members, if I can draw your attention to the recommendations of 5.1. The recommendation is that we approve the responses provided to the Audit Wales's, Audit Wales's inquiry of management, rather. Are members happy to agree that? Fantastic. Duly agreed. Item number 7 is the administration update. So still with Joanne, this starts on page 67 of the combined paper, combined pack. So Joanne, over to you.
Thank you, Chair. So the purpose of this report is to provide an update on the administration services provided by the fund. Starting at point 4, you will see information about My Pensions Online. So between the end of February and the end of May, 1,500 members registered for My Pensions Online, bringing the total membership up to 31,609, which equates to around 45% of the fund's total membership. There was a slight increase in the number of members registering during the last few months. This is as a result of correspondence that we sent out to members via email who hadn't registered for My Pension Online, encouraging them to sign up to the new system. And we plan to carry out this a similar exercise on an ad hoc basis throughout the year and going forward. So the numbers are pleasing. Moving on then to MacLeod. So work continues on the MacLeod project, and just an update to let you know that recalculations of pensions have now commenced, with the first payments being made in May and a number of further payments now being carried out in June. So we're making good inroads now into addressing the MacLeod remedy and making backdated payments to our pensioners. The next part of the report looks at the data improvement plan. So there is a requirement for the fund to measure its common and scheme-specific data on an annual basis. And this then is reported to the pension regulator. As a result of analysing the data, we have to also put in place a data improvement plan, which is available in Appendix 1. But if you have a look at 6.4 of the report, you'll be able to see the results from the most recent analysis that we carried out, which was at the end of last year. So you'll be able to see that the common data increased slightly and a very, very minor decrease then in the scheme-specific data. As I said, we do have a data improvement plan in place now to look at that, the data, and to try and improve that once again for the review that will be happening around November, December this year. Moving on then to some regulations, the Access and Fairness consultation to begin. So on the 6th of March, the LGPS Miscellaneous Amendments Member Benefits Regulations 2026 were laid, and these amend multiple LGPS regulations to bring about the changes proposed in the Ministry of Housing, Communities and Local Government Access and Fairness consultation. The changes are going to be implemented in a phased way, and phase 1 changes include survivor benefit and death grants, gender pay gap, gender pensions gap reporting, the MacLeod remedy and lifetime allowance. We have also received statutory guidance which sets out the expected timeframes for completing phase 1 of the regulation changes. From a practical perspective, the fund software provider has provided reports to us to enable us to identify the members affected. We've run these reports and we're currently working through them to identify the actual numbers of members affected. And then we will build that into our project plan to amend and rectify records resulting in backdated pension payments where applicable. The next set of regulations in the report are the Fit for the Future consultation response. So the pension scheme bill received royal assent on the 29th of April, and on the 21st of May, MHCLG publishes response on the technical consultation for the Fit for the Future reforms. And the LGPS Pooling, Management and Investment of Funds Regulation 2026 and the LGPS Amendment Governance Regulations 2026 were laid on the 21st of May. These will take effect from the 30th of June, and we are expecting accompanying guidance on pooling, the investment strategy and fund governance, and we're expecting that to be published in time for the regulations to come into force on the 30th of June. There have been some changes to the regulations following the initial consultation, so I thought it would be useful to set these out. The deadline for appointing both the LGPS senior officer and the independent person will now be the end of December 2026. The independent person role is to support Pensions Committee rather than become a member, and administering authorities can appoint an individual as an independent person, or they can procure the services from a firm. Pension Committee members must comply with the knowledge and understanding requirements within 3 months of joining or by their first meeting, whichever is the earliest. The conflicts of interest policy will be extended to pension board members as well as officers. The deadline for publication of the first investment strategy is now the 31st of March 2027, and the period within which funds assets must be under pool management following first participation in the pool has been extended to 3 months. The Fit for the Future reforms will result in a number of changes that the fund will need to carry out, and not least the independent person, and also a review of all the policy documents to bring it in line with the reforms, which the fund will be working on closely over the next 3 to 6 months. So that concludes the administration update, but I welcome any questions.
Okay, thank you, Joanne. As ever, comprehensive rundown of what's going on. So I'll throw it open to members. David's got his hand up, so I'll take David first.
Thank you, Joanne. Just a couple of questions, really. At point 4.1, you've got people registered on the old My Pension and the new pension, My Pension, so presumably there are duplicates in this, and it's a question of migrating the people from the old system to the new. Sorry.
Yes, so the old and the new, they are separate groups of people. But yes, the intention is to get members who are only registered on the old system to migrate across to the new. And hopefully these email notifications that we're sending out to members will ultimately result in the movement across.
I'll ask a supplementary on that. Is presumably, for data protection purposes, there's no ability for us to automatically transfer people who've signed up for the one or the other?
No, there's not. Because they have to log in, we changed the login process with My Pensions Online, the new system, so they've actually physically got to go in and log in themselves to be able to access the new system.
Okay, can I continue?
You may.
Yeah. I was just asking then, you know, I think it's good progress, and I'm not suggesting we have targets, but I thought of perhaps looking at targets to sort of get to a point here, and that may be a consideration for the future. Then, if I may go on to a second point, which was actually at 6.4, when you're talking about the data, common data schemes, civic data, etc. 2 points really. First of all, is there any kind of indication of where we sit in relation to other pension schemes? I.e., are we pretty good, or are we behind others? And then, is there any requirement or any anything that is set in terms of a target by the pension regulator? Do they comment to sort of say, well, you're doing well, or you're not doing well, or, you know, you've got to get this cracked by a certain time? I'm putting it in fairly vernacular terms, but you know what I'm getting at. And then finally, if I may, on 8.3, helpful to see those points. I guess it's really, have we started to give some thought to the independent person's role in supporting the pension committee, and whether we're going to follow common existing sort of practice, or whether we're set to change this? I don't expect that to be something that's a topic for this meeting, but I presume it will be a topic for a future meeting. But clarity would be appreciated. Thank you.
Thank you, David. Jo.
Thank you. I don't have figures comparing us to other funds, although I think this was something that committee had asked maybe last year when we brought these results, so I can get that information. I think overall, however, that our results are very high, and I will find out that additional information, but I do think generally we are doing very well with the results. The pension regulator hasn't actually given us a specific target to meet. However, I think what they want to see is that there's year-on-year improvement, and that we are basically aiming for that 100%. So that is what we are aiming for as a fund, but no hard targets in place for that. And then finally, just the independent person. So yes, over the next few months, we need to put we need to concentrate on this new role. We are still waiting for statutory guidance. Although we have received a draft of that, that's going to provide more background and information to us to help when we look to appoint this person. Also, I think as part of that process, we will be talking and working with other Welsh funds to see what they're doing, obviously to see, that we're coming at it from a standard approach, and also looking at our neighbours over in England as well, to make sure we put best practice in place and get the right person for that role. But work will really start working on that now within the next couple of weeks, months.
Thank you. Just ask one very small supplementary. It's just, something I should have and been tempted to ask before, but how many do we actually have in the pensions team as a whole? Because it's getting some feel. You talk about the range and breadth of work, but I still don't really have a picture of how many people are engaged in this, so that would be helpful.
So we have 26 members of the pension administration side, and then we have the 3 colleagues who sat at the desk here from the investment side. So around 30, and I think we've got 2 temporary roles as well, helping us out with MacLeod in the interim.
Thank you, David. Alfie, John, any questions from you? I've got one then, if that's the case. It's probably being a bit pernickety, but on the under the data improvement plan, I was just going through the data yesterday, and on page 73, at the bottom, we've said there's just over 1,100 incidences where we've got missing NI contributions or earnings history. Yep. I've got a question there. Is that where members are enrolled onto the scheme and we don't have information about employment gaps and NI holidays, etc.? Or is that where we've got members who are enrolled in the scheme who actually have gaps in their employment history and therefore, for example, their stamp isn't fully paid? Or as is likely to be here, is that potentially a mixture of the two?
The NI contributions was something that we historically held, that we used to have from our employers. Yeah. However, since the NI changed to not being contracted out any longer, then we didn't continue to hold that information. So it's not something that we collect now on a day-to-day basis. It does link to the GMP, which we hold separately, and is a separate issue there. So that really isn't having a material effect on members' records when we calculate their benefits.
Okay, fine. So essentially, you've gone belt and braces with the provision of this data about everything that could possibly be asked for.
Yes.
Okay, that's sensible. I mean, just to come back, if I may as well, Joanne, to David's questions under bullet point 8. Was it bullet point 8 about the fit for the future? I think what is quite interesting, having sort of sitting on chairing the LGBC and also sitting on the SAB and dealing with lots of the correspondence there, this was some of the deadline issues that were confronting other funds is definitely something that SAB has lobbied for, because I think there were some funds that hadn't really were not as forward thinking as what we were. I mean, I think what is encouraging is I think we would be in a position to meet most of the deadlines anyway, so well done us. But I think this is very sensible. I think actually sort of anecdotally, looking across the funds, I think the initial deadline about getting the statutory named individual or named post holder in place was actually causing problems to some funds because it sort of crept up on them, and the ability to get that person in position. Absolutely. So that's that. Okay. Anybody else got any questions? Happy to take any sort of thoughts from the advisors or members of the board present? In which case, members, if I can direct your attention to the recommendation that is on paragraph 10 on page 69 of the combined pack. The recommendation at 10.1 is that the committee members are asked to note the content of this report. Members happy to note the content? Excellent. Moving on then, item number 8 already. This is the risk register update. And I'll hand over to Lewis. This starts on page 77.
Thank you very much, Chair. So, this report comprises the quarterly risk register update, which I'm sure you'll all be familiar with at this stage. Before I start, I should point out that this update was initially scheduled to be delivered to the local pension board in January, and therefore the pension committee in March. However, this board meeting did not formally proceed due to key absences, and was therefore not formally scrutinised by the board until its April meeting. This also meant that this update was therefore not delivered to the pension committee in March. Because of this, there is now a slight time lag in the sense that the risk register you see today is not completely reflective of key updates in respect of potentially new and emerging risks that have arisen over the last couple of months. Rest assured, at the next pension committee meeting, we'll ensure that the risk register's coverage is fully up to date and will, depending on its mobilisation timeline, reflect key developments in respect of the new Wales Pension Partnership Investment Management Company. Okay, moving on to the cover report that you see before you. I believe I've sufficiently covered some of the background and context behind the broader risk management framework review and the outcomes of said review in previous meetings, so I didn't plan on repeating myself with this item. I will, however, briefly touch on this within the next item in the agenda when talking you through the revised risk management policy. I'll therefore keep this presentation fairly brief and just talk you through some of the most noteworthy changes and updates made to the fund's risk register as at the end of March 2026. So with reference to section 3 of the report, or page 77 of your packs, as you'll be aware from previous updates, we've now significantly involved the way in which the risk register is presented and reported every quarter, using the new snapshot and look-through documents which can be found within Appendix 2 and 3 respectively. The snapshot document depicts, at a high level, the top 10 risks faced by the fund with the highest residual risk score in descending order. This is then accompanied by the look-through document that provides a comprehensive profile of each risk, including the various aspects listed within section 3.2 of the cover report that you see before you. These documents are located from page 81 to 87 of your packs for your information. As a reminder, risks are now organised into 5 categories which are listed within section 3.5 of the report, replacing the 3 very high-level previous categories of administration, governance and finance, and investments. With reference to section 3.6 of the report, no material updates were made to the top 10 risks during this quarter. That is, there were no key changes to existing control measures or residual risk scores for each risk. We have, however, made updates to the officer commentary for certain risks where relevant and appropriate, and said updates can be found within the appendix, which begins on page 82 of your packs. Moving next, and lastly, onto the risk and theme review, which looks at section 4 of this report. The category selected for this period's risk and theme review relates to funding and employer covenant risks, which we believe was timely and appropriate given that the fund's valuation exercise has recently concluded. The full list of all funding and employer, or FE, risks can be found within Appendix 4, starting on page 89 of your packs. As is the case with the top 10 risks, all updates have been made in red text for your awareness. As part of this review, there were 2 noteworthy changes, namely risk score reductions made to the FE risks captured by the table in section 4.3 of the cover report. The first is risk FE4, a fall in risk-free returns on government bonds, leading to rise in value placed on liabilities. Gilt yields were significantly higher in March 2025 compared to March 2022 during the previous valuation, and this led to a significant decrease in the value of the fund's liabilities due to expectations of higher future returns. We therefore believe that the likelihood of this risk occurring has reduced and should now be considered as a low priority risk with an overall risk rating of 6. We similarly believe that the likelihood of risk FE7, which is the risk of an increasing long-term pension fund deficit, should also be reduced from 2 to 1. The fund's funding position has continuously improved during every valuation cycle over the past 12 years, including the most substantial increase as of March 2025 from 97% to 134%, based on an even greater level of prudence, up from 70% to 80% this time around. This has largely been the result of sustained strong investment returns, but also, as previously noted, due to a decrease in the value of the fund's liabilities at the March 2025 reporting date. We therefore believe that an overall risk rating of 4 is warranted, which represents how unlikely it is that we believe this risk will materialise, given the strong long-term trajectory of the fund's funding position. That was all I really wanted to cover as part of this quarter's risk register update. And as I alluded to at the start, next quarter's review is likely to contain a lot more substantive changes relating to the risk register to reflect recent developments, not only in respect of the new Wales Pension Partnership Investment Management Company, but risks that relate specifically to the fund as well. And I will pause there to allow for any questions.
Thank you, Lewis. That's very good. I'm just wondering, would it be helpful, members, if we went through the appendices and if there were any issues people had to work through them that way, or are people relatively happy with what Lewis has presented? David?
Yeah, I found it very helpful that the narrative changes were included. You know, it's clear to follow, etc. I think we've talked in the past about the sort of restructuring of the risks so that we actually have a broader spread and we can understand because I think they were a bit too high level before. And I think personally, I'm content. I don't think we need to go through it in fine detail. I think there's a clear rationale, clear overview, and given what you've said about there being a need to look at risk again in the next meeting in terms of changes relation to practical budgets, legislation, etc., I would be content to endorse this as it stands.
It's very kind of you, thank you. For what it's worth, I agree with David. I think actually the presentation of the information is very clear, and definitely having the updated commentary section is very helpful to see where we've to see the cogs turning in your head as you've been looking through the spreadsheet. Any Alfie, John, any comments specifically you wish to make? Any questions? Again, members of the board, I know you're much more involved in this process than what we are. I mean, if there's any reflections, have to take them. In which case, I'll take that as a no. Back to the recommendation then, which is back on page 78. So the recommendation is paragraph 5 on page 78. The recommendation at 5.1 is that members are asked to note the contents of this report and provide comments as appropriate. Well, we've given you some comments, and members happy to note the report. Excellent, fantastic, thank you very much. Back to Lewis, though, for the twin agenda item on page 93, which is agenda item number 9, and this is the revised risk management policy.
Thank you, Chair. As I just mentioned, before delving into the core content of this report and the accompanying draft risk management policy that's appended, I first wanted to remind members as to how we arrived here. I should also point out that, similar to the risk register item, this report was also intended to be formally delivered to members of the board in January and therefore to the committee in March, but this was pushed back for reasons I've already covered. I can, however, confirm that the version of this policy before you today was formally scrutinised by the local pension board during its meeting in April, and subsequent reflections from that meeting have been made to the policy you see before you today, where appropriate. So if you recall from the 2025-2026 Pension Fund Business Plan, we committed to reviewing the fund's risk management policy as one of the kind of core change activities of this document. With this in mind, over the last sort of 9 to 12 months, officers have completed a comprehensive refresh of the fund's approach to risk, which ensures alignment with LGPS best practice and the pension regulator's general code of practice, where risk management is a core governance pillar. Whilst not explicitly referenced in the cover report, we feel this review is also particularly timely given the ongoing UK government reforms to strengthen LGPS governance as part of the Fit for the Future agenda, including potential or pretty much almost guaranteed mandatory independent governance reviews, which we expect to become formally legislated later this month once the regulations officially come into force.
Stop there a second. Sorry to stop you mid-flow. Sorry to stop you mid-flow, Lewis. I'm conscious we've got an issue with the camera. I was about to ask colleagues online, could they still hear us at least, what it looks like? They can still hear. You can still hear us, can't you? Amazing. In which case, Lewis, plough on.
Okay. So the enhancements made to the fund's risk framework ensure that the fund is ahead of the regulatory curve, so to speak. At a high level, as a reminder, the work undertaken to date as part of the broader risk management framework review includes the development of a new risk appetite statement, which was approved by the Pension Committee in December of last year, an updated scoring matrix and evaluation criteria, greater and more explicit recognition of key risk indicators, or KRIs for short, and enhanced reporting mechanisms such as the new snapshot and look-through documents that were presented during the previous item. So the purpose of this report and the accompanying appendix is simply to demonstrate how we've reflected the work undertaken to date within a refreshed policy document and to seek feedback from the committee as to whether any final revisions are necessary before eventually, hopefully, being approved and published on the fund's website. So if I skip to section 4 of the cover report, which is on page 93 of your packs, this talks through some of the revisions that we've made to the policy itself, which can be found in the appendix to the cover report starting on page 95 of your pack. I wanted to emphasise that this review should be thought of as an evolution of the pre-existing policy that was first established back in the summer of 2023, rather than a complete refresh. The idea here is to ensure that the risk management policy, as will be the case for all other fund policies in due course, truly and accurately reflects what we actually do in practice. I should also point out that we're likely to continue evolving the existing approach to ensure continued alignment with best practice into the future. Now, I didn't plan on taking you through every single revision made to the policy on a word-for-word basis, but the table in section 4.3 of the cover report captures the most pertinent updates. This includes an evolution of the policy's aims and objectives. This can be found on page 96 and 97 of your packs. The addition of a new risk management framework section, capturing the core components and, where applicable, how these components are linked. This can be found on pages 97 and 98 of your packs. Updated graphics and visuals of the scoring matrix and evaluation criteria, which can be found on pages 99 and 100 of your packs. And an updated reporting section to capture the risk and theme review, which has been ongoing for sort of 18 to 24 months now, and to reflect new presentational changes to the risk register that you've become accustomed to. These can be found on pages 101 of your packs. We've also made sporadic changes to some of the wording and language used throughout, but the updates demonstrated by section 4.3 are, in our view, the most pertinent and that members should be most aware of. We did also consider attaching a track-changed version of this document so members could see exactly how the document had evolved, but due to the volume of changes implemented, it became quite difficult to read, which is why you see a clean version here before you today. Where practical and where tracked changes do not completely impair your ability to read, we'll endeavour to bring future policy updates as redline versions so you can clearly see how each policy has evolved. Although, given the extent to which most of the fund's existing policies will need to be refreshed, particularly post the mobilisation of IMCO, and to ensure that they are in adherence with the new regulation is expected to come into force. I can't make this a firm commitment, unfortunately. Now, I appreciate that Appendix 1, or the policy, the risk management policy itself, it is quite a fair bit to digest, particularly if you've not had time to review this beforehand. But I'd like to pause there and open up to any questions.
Again, thank you, Lewis. And again, I think well done. I think this is very comprehensive, and the way you've set it out is an improvement on what we've had before. Before I come to David, I'm just conscious again that Ian is the man who's been holding the pen on much of this for the past many years. Are there any thoughts or reflections you have on the information that Lewis has presented us today?
Thank you, Chair. No, we looked at this thoroughly at the pension board, both at the one that was not quote and at the ordinary pension board meeting. So the proposals, suggestions that we made have been incorporated in this draft that you've now got before you.
I love it when a plan comes together. David has already indicated he's got a question.
Thank you, Chair. Yeah, just a couple of points, really. I agree with the Chair. It's clear and straightforward, and it fits very well, obviously, with the risk register here and the breakdown of the risk categories, etc. First question is, I presume that this would become a public document once it's approved. See the nods there. Secondly, I think it's always helpful to have some indication of a review frequency. I would imagine at least once per council term. And then my only other one was that I could see a value for actually either including or linking to the risk appetite statement, because obviously it's a core part of the risk management framework, and I think I would find it helpful to see the two together. So it's just a suggestion rather than anything else. And then finally, obviously, you've already touched on the other point, which was how this then fits in with the new IMCO arrangements, which we know will have to have some kind of review. So essentially, we're agreeing this as is for the time in present. Hope that's helpful.
Very helpful. Lewis, any responses to Councillor Williams?
Yeah, thanks, David. All valid points, and I agree with every single one of them. The point about the linkage between this and the risk appetite statement is a good one. We've not yet published the risk appetite statement, as we were kind of unsure as to whether this needed to be a public-facing document or more of an internal framework that we use. However, I think I'll probably take this away with Joe and determine whether it can be public. Yeah, I mean, if we decide to publicise it, then we can make a clear link in this policy to it, so you can kind of see how each are linked. But no, a good suggestion and one we'll take away.
Yeah, I think we definitely should publish it. I mean, be as transparent as possible. Ethan.
Yes, regarding the risk appetite statement, I do think that will be a kind of a living, breathing document that we'll be referring back to multiple times, particularly now as we look at asset allocation, as it reflects the investment risk we're willing to take and we need to take, and then even at a broader level, the kind of the fund level risk appetite for, say, headline risk, for new ventures, for local investing. I think all of that will relate to our relationship with the WPP. So I think bringing that almost as a kind of a charter that we are referring to on a regular basis is a good idea.
No, that's very, very sensible. Anybody else? John, Alfie? In which case, members, if I can draw your attention to paragraph 6 on page 94 of the command pack. The recommendations are at 6.1. It's recommended that the Pension Committee, 1, note the contents of this report and the accompanying appendix, 2, raise any comments or questions as appropriate, and 3, to approve the revised risk management policy. So are members happy to note the contents and approve the revised policy? That is agreed. Excellent. Item number 10 then. This is the quarterly investment performance report, and this is for quarter 1 2026. The paper or the item starts on page 103 of the combined pack. And I'll pass over to you first. Yeah, it is you first, is it? Amazing.
Hello again, everyone. This item, which I'm sure you'll be familiar with, focuses on the quarter 1 or Q1 fund investment performance report, covering the period from the 1st of January to the 31st of March 2026. As I alluded to during the Q4 performance update back in March, which you may recall, the first quarter of 2026 certainly wasn't as rosy as the preceding periods, which was largely the result of increased market volatility amid the war in the Middle East, which began at the during the start of March. As a result, Q1 saw the fund post a negative return of minus 1.08%, which was around 90 basis points short of the fund's benchmark return. In monetary or nominal terms, this resulted in a decrease of just over £50 million to the fund's value during the quarter. I only wanted to cover off the headline performance figures within the executive summary, which is captured within section 3 of the report. The rest of the executive summary, though, provides a snapshot of the key takeaways you should be aware of as part of this update. But rather than repeat myself by taking you through the remainder of section 3, I'll delve into some of the most noteworthy updates throughout the rest of the report in a little bit more detail. I'll also skip over the market commentary segment for now, given that I'll shortly pass over to Ethan to provide a more comprehensive overview of the macroeconomic landscape surrounding the first half of the year. But once again, a high-level overview of this is available within section 4. Now, getting into the nuts and bolts, so to speak, I'll take you through the fund's Q1 individual asset class performance, and this can be found within section 5 of the report or page 105 of your packs. So, starting firstly with equities. The fund's equity mandates in aggregate delivered a negative return of around minus 140 basis points, or minus 1.4% in the quarter, which is a pretty stark contrast to the previous quarter, and indeed most quarters over the last 24 months. This, as I already alluded to, is largely the result of the sharp, broad market sell-off that occurred post-onset of war in the Middle East in early March, which completely wiped out all gains made in January and February, and then some, unfortunately. Despite the broad market sell-off, though, there was a notable regional divergence in performance as emerging market equities significantly outperformed developed markets. In terms of how this impacted the fund's mandates, this meant that the Fidelity Emerging Markets Fund contributed the most to overall returns, whilst the BlackRock Aquila ESG Passive Fund detracted the most. It's important to note that the aforementioned ESG fund, or the passive fund that I just talked about, not only has a large degree of exposure to US companies which struggled during the quarter, but also by design a lack of exposure to the energy sector, which rallied quite hard during the quarter, and therefore was detrimental to this particular strategy. In terms of active management performance, most of the fund's managers were unable to outperform their respective benchmarks during the quarter. This was the case for a variety of reasons, but suboptimal stock selection was ultimately the most common factor in terms of why they were unable to outperform their benchmarks. The Fidelity Emerging Market Funds, however, had the strongest active outperformance, whilst the WPP UK Opportunities Fund was the biggest laggard in that respect. Despite the challenging quarter, the one-year period presents a completely different picture for equities. Over the last 12 months, the fund's equity exposure in aggregate returned 18.5%, which, given the fund's large allocation, has been a massive contribution to aggregate portfolio-level returns during the financial year. Now, moving on to listed fixed income. So the fund's aggregate fixed income exposure, comprised of 2 different WPP sub-funds, generated slightly negative returns during the quarter, and both marginally lagged their respective benchmarks during what was, again, a relatively muted period for bond and credit markets, which is true not only of this quarter, but for the year more generally. Over the past year, the fund's aggregate fixed income exposure has delivered just shy of 3.4%. The role that fixed income exposure plays within the fund's portfolio is an area that will be reconsidered as part of the 2026 Fund Investment Strategy Review, which we expect to conduct both in conjunction with the new investment management company, but also with our existing advisors throughout the remainder of 2026. Updates regarding this investment strategy review will be brought forward to the next Pension Committee meeting and will likely feature representatives from the new Wales Pension Partnership Investment Management Company. Slight tangent aside, I'll next move on to multi-asset performance. The Fidelity Multi-Asset Income Fund, which is the fund's remaining multi-asset strategy, returned just shy of 1% during Q1, and this slightly underperformed its cash benchmark, which is measured by the Sterling Overnight Index Average, or SONIA Index. Over the past year, however, it has delivered just over 9.6%, which is substantially more than the cash return during this period. This strategy and other strategies of this nature play an important role in terms of asset class diversification and in maintaining the ability to tactically adapt to shifting market conditions, which is particularly helpful given the uncertainty that surrounds the current macroeconomic and geopolitical backdrop. The fact that this strategy was able to deliver a positive return during a period where most of the fund's equity and fixed income exposure detracted kind of reinforces this point. Next, talking about real estate, which for reference is captured by section 5.4 of the report, or at the top of page 106. The fund's UK property holdings delivered a modest return of only 3 basis points, or 0.03% during the quarter, and just shy of 4% over the past year, and underperformed the all-balanced property index fund, which is the appropriate benchmark over both periods in question. Something too important from an asset allocation perspective, though, is that the fund actually increased its exposure to real estate by around 2.1%, or just over £100 million in nominal terms during the quarter. This was following a new deployment into the CBRE Global Alpha Real Estate Fund, a solution that was collectively procured by the WPP as part of the Lot 2 real estate solution, which was agreed by the Pension Committee the tail end of 2024. A £140 million commitment to this solution, or as I just mentioned, was agreed by the committee last December, and the remaining £39 million, which is yet to be called, is expected to be deployed in the second half of 2026, demonstrating a major narrowing of the fund's underweight exposure to real estate. The fund also made a new deployment into the Bridges Alternatives Property Fund 6, which I'll provide more information about when I arrive at the private market segment of this report. In terms of long-term performance, I won't repeat every figure you can see within section 5.5 of the report, but the key takeaways here are that long-term returns are comfortably above the actuarial discount rate of 6% that was prescribed during the recent triennial valuation process, and despite underperformance relative to the benchmark in more recent history, which can be skewed quite heavily on a quarter-by-quarter basis, the fund has added value through active management since inception. And a breakdown of the performance for each of the fund's mandates on a kind of line-by-line basis is captured within Appendix 2, which can be found on pages 136 and 137.
Just stop there a moment. I'm just conscious I might go through this segment by segment to see if members have any questions. So any questions or comments on anything that Lewis has raised so far? David, John? No? Okay, carry on.
Thank you, Chair. Moving next on to foreign exchange and currency, which is captured by the latter end of section 5.5 of the report. Now, members will be aware that the narrative that you see before you in the report today is actually outdated due to an old version of this report erroneously being submitted, and I'd like to kind of highlight that error for it to be formally recorded. For awareness, I have circulated the most up-to-date version of this report to members outside of this meeting to ensure that members are up to speed. Instead of myself talking you through outdated information, I'll now pass on to Betty, who will provide a verbal update on the latest commentary in respect of foreign exchange and how this impacted the fund during Q1. And Betty, I'd be grateful if you could also, at a very high level, explain to members what FX actually is and why consideration of FX and currency is so important currently and will likely to be important in the future.
Thank you, Lewis. I'm using the subsequently circulated additional agenda item, and I'm right now starting on page 4, 5.6. And I do this section in conjunction with Lisa and Lewis every quarter, and it's probably one of the geekiest parts of the investment performance section, and I live for this type of thing. And it comes from a spreadsheet, which is cut off at quarter end, that Lisa provides me. And then I have amended that and I made my own model. And so each of the line items that you're invested in is either it's in whatever local currency. A lot of it's in dollars. Some of the UK ones are in sterling. There are a few things like these fixed income funds which are hedged back to sterling, even though they're probably mostly dollars and stuff. So so I go that line by line. My model then basically allocates these things based to currency. And some of the things like the big global index tracking things is an approximation of, say, 60% US dollar and then, some euro and things. So, I mean, it's not the most precise, but it's fairly, it's probably, it's correct. So, as of March 31st, nearly 60% of the fund's exposures are now non-sterling. and the remainder is either sterling or, as I mentioned, sterling or hedged back into sterling. And the reason this is important is, of the 60% roughly that's non-sterling, approximately 3/4 or 45% roughly is dollar. So that's why I focus mostly on dollar. I mean, think of all the things which are, say, hedged to the MSCI or global markets. Well, the U.S. companies dominate that so much, and people hear a lot about that. And you have exposure, so you have exposure to dollars. Because, of course, all of your liabilities are in sterling. So there is this inherent mismatch, asset liabilities of currency that, frankly, most people don't really focus on. And you haven't had to for reasons which I will explain on another page. But over the quarter, sterling depreciated very sharply of minus 2.2% versus the dollar over Q1. Of course, we had the breakout of the war in Iran. However, year on year, sterling has marginally increased by 1.8%. And there are various reasons for that. I might ask you please to turn to page 5, the next page of this supplemental things. You'll see there's a picture. I love pictures because they sort of tell 1,000 words. And this is, I write these things, I wrote this like sort of early June, late May. So it covers more than just Q1. But in this picture, right where you see in the graph 2026, you see there's a sort of sterling, the lines are jagging, going sort of up. And that's about where the quarter started. And then where you see it goes up sharply, and then it goes down to about the lowest point. You see right where it says April. There looks like there's a W. The bottom of the first W, that's March 31st, which is when your quarter ended. Okay, so from say sterling decreased by 2.2% means from the December 31st to March 31st. That's what that means. It doesn't mean this was a straight line. In fact, it's anything other than a straight line. This looks like a yo-yo to me, and in fact, it was. Because the first part of the quarter it looked pretty rosy. People were talking about Fed rate cuts and things like that. And if all things equal, if people are cutting rates, it means a short-term interest rate that you could get on, say, cash would be lower. So the attraction of holding, say, dollars in this case would be lower because you just earn less at the bank. Okay, so people were talking about, Fed rate cuts, how many is it going to be, and all that kind of stuff. Well, that turned around, and especially when the war broke out in March, end February, early March. These types of events quite often lead investors to a flight to safety, it's called. Now, of course, the U.S. dollar has come a bit under question. It's no longer the currency that people reflexively go into when crisis breaks out, sometimes because it's caused by the U.S., unfortunately. But nonetheless, you also have to remember that sterling is a pretty small part of the global market, and it's we depend on the kindness of strangers to fund our deficits. There's no reason why anybody has to hold sterling in their portfolios, whereas, for example, euro is a much bigger block, and dollar, these are the bigger blocks, and even yen. So sterling is sometimes a currency of choice or relative value in the eyes of investors, whereas for us it's pretty critical. That being said, we need to manage this risk. All else equal, paying our liabilities in a cheap currency is actually an advantage. Imagine if you were paying American, U.S. liabilities in dollars, trying to fund it with a multi-currency portfolio, and your currency, your liabilities kept appreciating. That's a real challenge. We don't have a constant challenge. So I always call this sort of the tailwinds of weaker sterling is a tailwind. However, sterling is over the period here, which is a year. You see, it's kind of gone up and down and swung around, and it swings and roundabouts, but it's kind of ended up more or less in the same place. So it's just been very volatile intra-quarter. Now, because a sterling was weak, then it flattered our picture at the end of March 31st. If sterling had been expensive, when we translate non-sterling assets into sterling, it would have been weaker. So there is a risk, there's a translation risk. And if that happened, for example, on the 31st of March, if sterling spiked on the 31st of March of a time when you were doing a triennial valuation, suddenly your assets would just translate into less sterling, and your funding ratio would then appear as lower, even if the next day sterling traded down. Okay, so this is sort of the risk that we need to, first of all, consider very actively. Realize this is an inherent risk. Nobody likes to talk about it because it makes people's eyes glaze over, but it's an issue. and then potentially consider whether we jointly with WPP might eventually want to think about managing this. Now, if you look back into history, since Brexit, the maximum value that sterling's had against the dollar has been about 1.4. Some of us possibly remember from travels about 10 years ago when sterling bought you more. However, even earlier that, there were times like in 2007, before the great financial crisis, where sterling was 2.0. So depending on, the confidence people have in sort of leadership here, control of budget deficits, inflation and all that kind of stuff, sterling can be much stronger than it has been recently. And if sterling strengthens, there is a risk to all LGPS portfolios and frankly all defined benefit pension funds, which is why I think this is something we need to maybe add to a bit more discussion of in the risk register and risk tolerance, and think about whether we want to manage this. I would also say one last thing. There are sub-funds which automatically hedge you back into sterling. However, that is very expensive. You don't, however, see that. We just see the net results of a fund which is hedged, but actually they spend a lot of their money trading futures and forwards and things like that, and actually trading out of a currency like dollars, which might have appreciated, buying the losing currency. So you lost money on that. But it's all invisible in the way that it results. So I think we need to also unpick that a little bit, because there is a lot of money being flowing out, and we need to say, does that make sense? So anyway, this is why I focus on this. It's just something to be aware of. Up till now, it's been generally fairly benign, but we can't have our eyes closed on risks like this.
Thank you very much, Betty, for that incredibly helpful and comprehensive update in respect of currency. And rest assured, during next quarter's update, I'm hoping that it won't be the case that you'll be reading an outdated version, and it'll be fully reflective of the most recent commentary. Moving on, next I'll talk you briefly through asset allocation progress as at the end of March 2026, which starts on page 108 of your packs, or section 6 of this report.
Before you do that, members, any questions specifically to Betty, or what she's just talked us through? David.
My recollection is that this has been raised before by yourself, Betty, and I'm just conscious that it's something that's being flagged for us for, if you like, an awareness. But is there a particular, or is that something you're going to come on to, Lewis? Is there a particular strategy, perhaps, for how you address that in terms of, either accepting the variation and looking at the sort of longer term, which is what we tended to try and do in pensions, isn't it? Or whether there's a little bit, because you did seem to be suggesting that the kind of hedging in itself was quite expensive, and there's a perhaps limited mileage in that.
Yes, and I do apologize to anybody who thinks that I kind of clear the room with talking about currency. You can tell me to stop. I won't take it personally. Yes, there are ways that we could look at this. I think this might be part of the revised SAA, Strategic Asset Allocation work that we do, because, for example, some of the things which Lewis alluded to, already relooking at, say, some of the fixed income allocations which are hedged, we might think that there might be better use of that capital. But were we not in a transition towards WPP, I think we would have greater latitude possibly to consider ways we might look at how we could possibly manage. I mean, the short answer is, if you think sterling is going to appreciate, you want to hedge it. If you think sterling is going to depreciate, you want to take that windfall and not hedge it. It's like buy low, sell high. That's what But anyway, but that aside, there are strategies to do it now. In full candor, as Ian and I know at another fund that we both advise, they put this in place painfully in beginning of April 2025, when the sort of dollar sterling started going a bit crazy right in the Trump liberation thing, and it's been a bit painful because there is a lack of any direction with the sterling and dollar. It's because that seesaw effect. But if you take a longer term view, I think we might at least consider, but probably have to work with WPP, because I think this is something that could or should be of interest not just to us but to all of the funds. But it does, of course, have cash flow and other impacts as well.
Joanne.
Yes, sorry, just picking up on what Betty said. Yeah, I think it is something that we will, when we sit down with WPP, have a look at that point and make sure that's built into our SAA going forward.
And I think further education on this point, including maybe with external providers who do this all day long, should be part of the process so that all members here have gotten up the learning curve.
Make a note of that one. Okay, Lewis, back over to you for item paragraph 6.
Great, thank you, Chair. So firstly, the pie chart in section 6.1 of the report provides a kind of high-level visual of the fund's current versus strategic asset allocation. This is then subsequently broken down on a more granular mandate-by-mandate basis by the asset allocation table within section 6.2 of the report. A similar story continues to prevail in the sense that the fund continues to be overweight to equities relative to the strategic long-term target weight of 57%. However, with reference to the point I made earlier about the large deployment into the new CBRE Global Real Estate Fund, this gap has narrowed quite substantially during the quarter. This can also be demonstrated by the fact that our largest individual allocation to the BlackRock passive product has seen a 3.8% allocation decrease. So this BlackRock product, alongside the BlackRock European Equity Fund, has, and in the short term, will continue to be the primary source of liquidity to satisfy private market and any real estate drawdown commitments. And this was certainly the case during Q1. And I think this is actually quite a nice segue into the only other point I wanted to make in respect of asset allocation, and that is regarding the fund's cash position as at the end of March. As depicted by the asset allocation section in 6.2, the fund held just shy of £80 million in cash at the end of the quarter. This was because in early March, £170 million was redeemed from the fund's passive exposure in preparation for the large deployment into the real estate fund, alongside expected deployment into other private market strategies during the quarter. Now, only 75% of the total 140 million commitment to the Global Real Estate Fund was called, which meant that the fund held excess cash at the end of the quarter. I can now say that as at the end of April, the fund's cash holding has reduced to £54 million, or just over 1% in accordance with its strategic asset allocation, and we expect this number to return to the typical sort of 10 to 25 million operational range once the remaining 25% commitment has been fully deployed. As I've mentioned during previous updates, fund officers, in conjunction with the fund's advisors and the new Wales Pension Partnership Investment Management Company, will seek to establish a more sophisticated cash management strategy approach over the coming months as part of the 2026 investment strategy review. And I'll ensure... Sorry. Just to finish that point, I was just going to say that I'll ensure that members are informed of any sort of concrete updates in respect of this once notable progress has been made. I'll pause there for any questions.
Before I come back to that, do you want to talk through the rest of the report? Is there only 2 paragraphs away from it? Then I'll come on to David, then we'll go on to Ethan.
Sure, no problem. So penultimately, I'll touch on private markets, which starts at the bottom of page 110 of your packs. So the fund's private market mandates now span 19 different investments across infrastructure, private credit, forestry, and now real estate. The aggregate commitment to these mandates, as at the end of Q1, was just over £1.25 billion, and pleasingly, over £710 million of that commitment, or around 57%, has now been deployed. The table in section 8.2 of the report provides a breakdown of all 19 of the aforementioned mandates, and this includes the total commitment, amount deployed to date, amount deployed during the quarter, and an indication of performance for each separate mandate. As a reminder, the fund uses the multiple on invested capital, or MOIC metric, to analyse the estimated performance of these mandates, and this figure becomes more meaningful over time as funds mature. You'll notice that some of the 19 mandates have MOICs less than 1. This is normal and is quite typical of strategies that are in their infancy. This is largely because of something called the J-curve effect, which I believe Betty might have touched on before. But this is essentially where, during the early stage of many private market investments, management fees and transaction costs are incurred before the underlying projects have grown out sufficiently to create value. Then, once these assets mature over time, valuations typically, in the case that we might hope, begin to increase, which results in positive performance over longer-term time horizons. It should also be noted that, unlike within public markets, such as equities and bonds, private assets are typically valued on a quarterly basis, so it often takes longer for the intrinsic value of these investments to actually be reflected in the top-level asset prices. I believe I mentioned this during last quarter's update, but I just wanted to reiterate that since the previous investment strategy review back in the end of 2023 in December, the fund's nominal or monetary exposure to private market investments has increased by around £500 million. It is the excellent performance of the fund's equity exposure over the past 3 years, coupled by the slower than what would ideally be preferred deployment of capital into these private market assets, which has inadvertently prevented the fund from achieving its long-term strategic asset allocation. Nevertheless, progress continues to be made on that front, and we expect this progress to continue once full investment implementation is delivered by the new Wales Pension Partnership Investment Management Company on our behalf. The last point I wanted to touch on regarding private market investments is investment into a new strategy, which I alluded to earlier, in the form of the Bridges Alternative Property Fund 6. So the fund committed a total of £30 million into this strategy back in October, 10 million of which has been, 10 million of this 30 million was deployed during the quarter. In accordance with the fund's impact investment policy, fund officers received delegated authority to pursue this investment because the total commitment of £30 million does not exceed 1% of the fund's value, which at the time of the investment would have been around £50 million. In terms of what this investment entails, in essence, this project invests in property and in needs-driven sectors where opportunistic strategies such as this can generate attractive financial returns alongside societal benefits. This strategy aims to deliver positive impacts such as providing lower cost and affordable housing, revitalising undeserved areas, and providing workspace logistics for small to medium-sized enterprises or SMEs. After conducting appropriate due diligence, it was deemed that, alongside the investment case for this strategy from a risk-return perspective, the project was entirely appropriate due to its alignment with the objectives of the fund's impact investment policy, of which regeneration, affordable housing, and SME finance are all kind of key pillars or non-financial objectives. I'm more than happy to circulate kind of recent reporting in respect of this fund to members for information if this is of interest, just to give you a flavour of the types of individual projects that this fund prioritises. Speaking of the fund's impact investment policy, it's likely that this will be comprehensively refreshed and reframed over the next 12 months to ensure alignment with the new regulations in respect of local investments, and this exercise will likely be conducted alongside the new Wales Pension Partnership Investment Management Company. I was going to pause there, Chair, but would you prefer me to finish the rest of the report before pausing? No problem. Pleasingly, just coming on now to the Q2 quarter-to-date update, pleasingly, the fund managed to recoup the loss posted in March and more during April, which saw its value increase by over £200 million, or around 4%. Ethan will shortly be able to add some colour and context to this increase during her macro update, but from our perspective, it was pleasing to see a strong reversal in April. Finally, just to conclude, at a very high level, the fund posted a negative return of minus 1.08% during the Q1 and underperformed the benchmark return. Despite the negative absolute and relative return during the first quarter of 2026, long-term performance remains strong in absolute terms and is importantly in excess of the discount rate set by the fund's actuary. Lastly, noticeable portfolio rebalancing occurred during the first quarter, and the fund's portfolio will continue to be rebalanced in accordance with the fund's strategic asset allocation, but this will be conducted on our behalf by the new investment management company once it is formally mobilised, which we expect to be the case hopefully in the next month or so. I'll finally pause there, which I'm sure you'll be glad to hear, and allow for any questions.
Thank you very much. So David and Betty have expressed an interest. So David first, then Betty, and I'll take any of the members after that.
Thank you, Chair. And it's really just a couple of observations for ease, really. On page 109, where you do the breakdown of the investment strategy, you gave the explanation as to why cash was high in terms of it. I just think it might be quite useful to just put that as two separate lines so we can see quite clearly what's the investment accrual and what's the cash held, because I think it just means that the narrative then becomes clearer. And then on a similar basis, on the table on page 111, again, I think in terms of that understanding, it could be quite helpful to actually have a column that sort of says when the investment was made, so we know that those things, we can see very easily what's come on later, we can see how the returns are progressing, and we can see something that's new. And it would be helpful possibly to put that in red just so that we know that that's the case. Just again, just hopefully constructive suggestions to make it easier for analysis and understanding.
Thank you, David. Betty.
Yes, exactly. I was going to say also on page 111, especially as Lewis was talking about doing more things aligned with either our, our investment beliefs or impact and things like that, as a few of some of the portfolio holdings are now showing. A lot of times we're investing in smaller companies or new ventures or just newer ways of rethinking industries, all for sustainable reasons and things like that. And I think, we need to just be aware that sometimes this includes, greater risk, or that things may not work out as anticipated. And whereas when you're talking about big indices, these are dominated by large multinational companies. You don't worry about whether they're going to stub their toe or whether the business plan is going to have to be rethought or something like that. And I think that is a normal part of the business. But I think, we're starting to get invited to, extra discussions of investors about, the need to do this, that, or the other, or, focus holding these things longer and improving performance to make them more attractive targets down the road. Or just in general, there's a lot of, things in the press about private equity firms having more difficulty exiting some of the investments they may have held for a number of years or at not the prices that they had assumed. So all of this is inherent in this investment activities. This is why it's good to have, diversification and also be working with very strong managers who not only can buy something, and it's not just about buying and flipping, it's about buying and really working with things and helping small companies transform, change the management or whatever. And these are very relevant skills, and we certainly hope that will continue to be the focus once this all shifts to WPP, but it certainly was when we put these things on. But now we're starting to see, having to be a bit more patient and sitting with the managers as they work through some of these things, or sometimes giving waivers and things. So that's another part and parcel of being in this business.
Thanks, Betty. And just in response to your observations, David, so I agree with both points. Just for your information, the accruals aspect of cash makes up a minute percentage. So just as of March, the accruals were sort of 336,000. So we could still split them out if you think it would be helpful, but we've just combined them purely because accruals, they are there, but they make up such a tiny portion of that line item. The second point, however, completely agree. I think that sort of really brings to life what I was saying about how the maturity of private market investments impacts the MOIC figure that was delivered, and we can certainly implement that as part of next quarter's update.
Excellent. Thank you very much, Lewis. Alfie, John, any questions? Yep, Alfie.
Just a quick question about the strategic asset allocation and how it's going to work in the new WPP company. So I understand that, and this might be wrong, so correct me if it is wrong, that the authorities will still set the strategic assets allocation with advice from the WPP. So is it likely that there'd be a review of SSA once it's all up and running?
Good question, and the easy answer is yes. Yes, SAA will be a key component of the review, and it kind of probably one of the most important aspects of the review. Perhaps less so now that investment implementation will be delivered by the pool. And one thing I would say is that we don't expect to implement significant changes to the existing SAA, given that we've still not actually reached our allocation targets for most of them. So likely to be light touch in respect of that. But yeah, SAA is certainly something that will be considered as part of the investment strategy review.
Just quickly, just on 10.3, where obviously the funds portfolio will continue to be rebalanced over time. So the WPP will be working to our current SSA until it's reviewed.
Correct. Yes. Yes. And all implementation behaviour, so the buying and selling of assets, the rebalancing of certain assets into other asset classes will all be conducted for us by the pool on our behalf. We'll be notified of it, but they'll kind of have full autonomy over investment implementation decisions such as that. Yes. I think Betty had a question.
Yeah, I just want to say, I think there may be a few changes in the SAA, because last time we did this, our discount rate started with a 4, and now our discount rate is 6%. And that's the rate you need to generate across the whole portfolio just to stand in one place, because that's the rate at which your liabilities, compound with no change other than that. So I think, when you have certain allocations which are returning less than 4% or something like that, I think we need to ask ourselves, why is this here? Because it doesn't even, it really puts more burden on some of the other allocations. Now, there may be reasons, but I think one needs to think afresh and not just sort of take, convention has it, you always have allocations to this, that, or the other, because you say, does this make sense?
Thank you for that important clarification, Betty. I think it will be quite interesting going through the process, as Lewis has alluded to. We're actually going to be the first of the funds out of the stocks to be working with the pool on the strategy refresh. So I'm looking forward to that, because again, as their emerging thinking will be evolving, it's quite good for us to actually get around the table and to be setting the yardstick for this. So lots of opportunities to get stuck in over the next couple of months. So thanks, Lewis. That finishes your section of this report. So over to Ethan, please, if you could talk us through the macro paper, which starts on page 115.
Great. So just as a reminder, this is designed to give macro context to the conversation we just had about the portfolio, its performance, its allocation, so its kind of readiness going forward. And in other panels I sit on, I sometimes give this report first, but I actually think it's better now to give it because it puts some of the action we're doing into context and explains a lot of that. Because, as I'll describe, there are some pretty divergent, developments in markets currently, some positive, some negative. And what we've also seen is a reaction to that, which is a rotation away from some of the higher performers into the lower performers. And usually that's a healthy portfolio diversification discipline to do that. And as Lewis has just pointed out, that rotation, that diversification, that rebalancing and as reorientation of our portfolio according to its targets, its strategic targets, is something that we're continuously doing. So as I'll illustrate, we are continuously taking profit where there has been a surge and actually reallocating that into areas that represent good value today and perhaps are overlooked today. So I would say that it is, it's not always the case, but it is the case today that the prevailing narrative quite starkly justifies what we are doing at portfolio level. So that's all very good news, and I think just reaffirms that we are on the right path. So this was dated early June, so just 5th June. So it has captured most of the second quarter, most of the reversal that Lewis mentioned. What we spoke about in the last quarter was really a sort of a culmination of some of the malaise relating to geopolitics. There had been a very strong end to last year, with equity markets reaching new highs. We'd seen metals do very well, we'd seen gold do very well, and we were coming off the back of that kind of boom, with then the uncertainty around the geopolitics and the war in Iran having kicked off and having led to higher oil prices and higher prices, higher inflation, and potentially then a reversal on interest rates. And like any geopolitical surprise, that generally does sow doubt in markets, and markets were quite bearish about what that could mean for, at least for companies and their profits. But the kind of saving grace, time and time again in the last 18 months, has been the AI juggernaut that has been moving through primarily US markets. And as you know from your allocation, most of your allocation to equity markets is in the US, is to the US dollar, and that has been a very strong kind of supporter for your portfolio. So what we've seen then in the aftermath of that, let's just talk about inflation first. Clearly inflation is not yet back in the can, as we'd hope it would be. This is, some of it's due to the rate of fuel and food price inflation that is directly attributable to the Iran situation, the closure of the Strait of Hormuz. This has generally affected European and Asian markets worse than it has the US markets, because they would be more dependent on energy coming from there, and they don't have that strong supportive growth that is in place in the US. So as that spike has persisted, that is then, not only has it created more pain for the consumers that can't put fuel in their car and have no choice but to buy the food basket they always buy. So it has been affecting the lower-end consumer more than the higher-end consumer, and that has reflected in consumer sentiment. And we might just call that consumer the consumer that lives on Main Street, that doesn't participate in Wall Street to the same degree. We've also seen that now reflect in interest rate expectations, whereas we were heading towards a kind of a rate decline and rates being cut. This surprising spike in inflation and the lack of, I suppose, the fact that jobs have been strong, and the concern that central banks have that there will be an overheating in the economy, has led to there being a pause in rates in the case of Bank of England and the Fed, and actually an increase in rates in the case of the ECB, the European Central Bank, and Bank of Australia, just as two examples. So if we think about that and how it impacts the consumer here in the UK will struggle if we see rates go up again. The flexible mortgage payments, adjustable mortgage payments will again take a higher share, and that all reflects, I suppose, poorly for the consumer and how they're likely to fare. Companies too will also suffer from increased borrowing costs. So that has been another phenomenon that we're seeing just now. Moving to AI, so clearly there's been a phenomenal run in equity markets, particularly in the US. I'd say that has been felt globally. There have been strong performance, and I'm just going to move to page 118 here, where we look at across the board at other equity markets. You can see that even in the case of the S&P, the stocks, so that would be, sorry, the FTSE 100 and the stocks, these are perhaps older economy stock markets in the UK and Europe. They've all at least had positive performance year to date, have done well over the last 12 months, as Lewis pointed out. And then, of course, the tech-heavy indices, such as, say, the NASDAQ, has done extremely well. And then we've had something like Japan do exceptionally well. So we are exposed across the board to these very strong momentum-led markets. I've used something that describes it as a melt-up. There is some concern that between the large amount of funds in money markets, the sense of FOMO, of not participating, being worse than participating in some cases, has been driving strong momentum into this area. We know there is a lot of money on the sidelines in the form of 8.3 trillion in money market funds. So even these, the concerns around markets being strong and the kind of occasional pullbacks we have, they don't last very long. So we have a very strong momentum around that. There's a lot of uncertainty, however, still around the AI thesis. And we do see that pop up from time to time when the momentum subsides. We saw that just before we had the positive, say, ceasefire news. There was some concern around AI regulation, anti-AI populism, and some sense that maybe if this does start to crack, it could fall apart like a house of cards. And that is still, there is a lot of interconnection in place around some of the tech names, and that's something that we're watching very closely, which is precisely why a portfolio like yours that is not only exposed there, and reasonably high exposure to equities relative to your peers, but you've exposure across European stocks, UK stocks. That's all very positive, because the rotations, when they happen, what we've seen is they are generally from tech into non-tech, from large cap into mid-cap and small cap, and from the US into non-US. And all of those rotations are ones that you're participating in, and not only at the equity stage, but equally at the where you're rotating into real assets, such as forestry, which is much less volatile, much more long-dated, into infrastructure, again, inflation participating and very long-dated, and real estate, which has definitely, I'd say, reached the peak negative sentiment. It's comparing it to AI with its peak positive sentiment. Real estate, where you're allocating, is looking positive today because it is coming in at such a low potential valuation. So all of those rotations are still very much in place in the markets. You are now taking place, participating in that. Clearly, in the last few weeks, we've seen the SpaceX IPO last week, again, another example of the huge froth. And then we've seen the ceasefire announced just over the weekend, which is likely to lead to another leg of a positive momentum as the oil price falls to a 3-month low. And we look at a potential upside from those prices coming down. So clearly, I said here in the portfolio outlook on 124, what are we looking to see in the next 6 months, second half of the year. We have had a resolution, or at least it seems, of the situation in Iran, which is going to be positive for prices, at least at the headline prices as oil comes down. Also will remove some uncertainty, say around airlines, aviation fuel and the pressure on them, and other stock markets. So something quite positive there. AI's messy integration is going to continue to be a major issue as we look to the end of the year. There will be, as I said, the populism, the more regulation, more IPOs that are slated to go ahead, and this whole impact on jobs, impact on profitability, likely to be very much in focus as we look to this. This is very much related to one of your areas of alternative, which is private credit. We do know that some private credit is exposed to software. That is one of the areas that could be undermined by AI's march. And we do need to look carefully at whether, we've asked this question, whether our private credit managers are as exposed to this as they could be. But overall, the rates situation looks to be stable or rising right now. So that is going to be, again, going to have some impact on your portfolio assets. But again, back to the mantra of rebalancing, diversifying over and over again, keeping awareness of your risk horizon and the strategic asset allocation that you have and are likely to have. I would feel at least quite confident that you are well positioned in this current mix of direction of assets and to really keep doing what you're doing in that respect. So I'd be happy to take questions on the macro backdrop or otherwise.
Thanks, Ethan. Fascinating as ever. I've got Betty and Steve. I'll take Steve first, if you've not heard from me today. Did you have a question as well? Oh. Yes, I'll take Steve, then Betty, and then I'll come back to David.
Thanks, Chair. Just very quickly, with the G7 going on this week, I just wondered whether you felt there was anything that could come out of that. There's very high-level discussions, obviously, but whether there's anything that could come out of that G7 this week, which we need to keep our eye on.
It's a great question. I say, looking back to Davos and to other kind of similar multinational get-togethers and statements, I would imagine some of this is very high-level policy that we're going to see. Clearly, we have a couple of things. The tariff situation is still not quite been resolved. It has moved in and out of the headlines, so I think we need to think about that as far as its ability to disrupt. There are still 2 years left, at least, of the Trump term, and there could well be policies that come about there. We know that AI regulation, there's different speeds being adopted across different countries regarding, say, social media restrictions and even regulation, which is clearly more at the fore in the UK and Europe, so I think that's going to be at the fore. When we think about general geopolitical alliances, etc., I think that the Mark Carney middle powers discussion is quite salient in terms of how that we think about the relative sway and, I suppose, influence that different powers have. So there will be some observance of that. And otherwise, the US is certainly setting the standard when it comes to AI advancement, innovation, etc. And I suppose as other countries look to that.
Yeah, I think it's just really important to remember that throughout the whole, COVID and all that kind of stuff, and even since the Great Financial Crisis when we had low interest rates and things like that, there was sort of an offsetting relationship between, fixed income or things with the duration exposure to the interest rates and equities and stuff like that, and they kind of self-hedge. Well, that is pretty much gone now. Now they can sometimes trade more, with higher level of correlation, and that's because we are in a interest rate regime which is higher, and also inflation is higher. So it's no longer there is no longer a kind of what you call Fed put type of thing. And interestingly, when the war in Iran broke out, equities tanked and bond yields spiked. But then in April, equities have kind of it did a V. Bond yields stayed high, and they're probably staying higher. And that's because of everything we read about the need to, people don't want to tax anybody, and there's more spending on defense and things like that, and that just puts a lot of pressure on bond yields. And so we have these asset classes like real estate or fixed income and stuff like that, which are basically priced off government bond yields, and it's very hard to see how they are going to appreciate or perform well if government bond yields are still sort of trending up. and they basically get priced kind of like a bond. So I would actually say that, you know, it's not necessary. You can't necessarily assume that rotation will work the way it used to work in a low interest rate environment. So that's why I would be very cautious on anything which is either expressly has duration, like things which are like based on a bond yield, or has duration because it's measured based on a cap rate, which is basically a bond yield. And this is one of the things that I keep banging on about in the SAA, and will bang on about again.
David.
Yeah, thank you, Chair. I suppose just a couple of points, really. I think the first one is, obviously, we might expect to see, with the announcements about the treaty, etc., we might see traffic moving in the Straits of Hormuz. And I think one of the big things that was probably less appreciated was how much there was dependence on fertiliser that was coming through there as well, and the impact on agriculture, etc. So I think that's probably one of the things to be aware of, and that's also something in terms of our overall investment approach, I guess. Secondly, whether we've seen any boost to renewables as a result of the restrictions on the oil flow, and whether that's also providing opportunities, you know, globally and nationally. And I think the last point was, again, I think there seems to be some, today or yesterday, Donald Trump's looking to restrict some of the AI access, so that's likely to have an impact. Is that opportunity in terms of better investment or scope within Europe? I'm just, three things that seem to be quite topical, throw them in there.
Yeah, it's a great point, and I didn't get to all of those trends. And I think there's a great point, starting with the this was the Strait of Hormuz. Clearly, I think what the lesson learned there is the single point of failure was very dangerous, and there's an immediate attempt to reroute and to diversify. And that has been, we saw that during COVID, that, you know, having these supply chain, I suppose, concentrations and single customer concentrations were always dangerous. So all of that, I think, are healthy reminders of the need. And I would say that what it has been surprising is, despite the fact that this was a fairly dire outcome in terms of oil passing through, the fact that there wasn't a more broad-based effect shows perhaps the lack of reliance on oil as we thought, maybe compared to the 70s, and equally the ability to quickly come up with, I suppose, backup plans or plan B around that. And that was certainly the case around some of the traffic through that area. In terms of the energy, one thing I didn't even mention in terms of a big kind of mega trend is Financial Times talked about this kind of beginning of a super cycle. If we're at the beginning of a super cycle, not only around AI, but also energy and defence. And all of that is tied to the same geopolitical critical crisis we've had here. If Jensen Huang is suggesting for the AI use we need 1,000 times the energy that is currently in use, not only does that suggest a certain lack of sustainability and lack of responsibility perhaps, but there is a need to source energy from wherever it can come, including sustainables, and I think renewables. And I think that we would think that bodes well for renewable power, because there has to be power no matter where it comes from, essentially. So that, again, for that. As far as AI, I was touching on this AI regulation, whether a couple of things are in place. We've seen already a reflection that token maxing may have its limits, that pricing may come down. We've seen OpenAI about to slash that, and say the likes of Uber say that they are going to segment their use of AI from the high performance models that are needed for certain tasks, and then be satisfied with a more commoditized, maybe open source model for the 80% of tasks. So if there is that kind of bundling and segmentation, I think that's going to really have an impact on the projections of the large AI companies, because their pricing was very much probably based on the status quo and not based on this kind of consumer segmentation. So on that basis, I'm not sure that export controls on the Mythos model, or Fable, this highest end model, will necessarily negatively impact Europe and its potential importers that much, because I don't know how many companies were actually using the highest end model, or whether they'd be satisfied with a lower end model. So I'm not sure that itself will affect Europe's progress with AI. I think what it does illustrate is just how quickly this thing is moving, and how quickly we've even seen suggestions of the US government take a 50% stake in some AI companies, and even that seems to have bipartisan approval, it looks like. So if that's the case, that would seriously undermine the business case of many of these. It would certainly support them, but their earnings case could be undermined. So that is what we need to watch, and why this heavy momentum-led concentration in these stocks can be difficult in a portfolio, which is why your approach of being diversified is very important, and taking profits where can be. And I'm hoping that WPP and they will be taking profits on the clipping the flowers and watering the weeds, which is exactly what diversification and rebalancing is for.
I've got some comments, but better I'll take you quickly.
Yeah, just recently, I actually attend and get invited to even to speak at some conferences now. There's a lot more focus on defence. I'm actually speaking at one in Switzerland tomorrow, which is interesting, given their supposed neutrality. Virtually, by the way, I'm not going to Switzerland. But one thing that's quite interesting is the whole issue of resilience and security. Some people say, ESG is now energy, security, and some people say guns, but it's the whole energy sufficiency, resilience, which really means are renewables, because we don't have, European countries and these don't have a lot of oil reserves, and then defense, security. These are kind of converging themes, and the words are the same, and they're being more and more consciously, bundled together, which is probably good for, development of renewables and backing away from fossil fuels. The idea is that fossil fuels are really, they're a trap. And also I was at the Quinbrook AGM last week, and they are going gangbusters, and there's just a huge amount of demand for wind for everything, and also they're looking to exit some things. And so this is definitely, even though people are maybe shifting the words they use about it, this is all about resilience. And then even British energy, and the people that actually just use British energy and stop talking about net zero, people will be a lot more positive.
I think the conversation is more about resilience and security now.
But this is the point I was going to raise. I mean, and maybe we can take this up again elsewhere. So basically, I mean, if Trump is raising the spectre, or actually, I'm being pejorative about it. Trump is potentially raising a return to, or the US getting involved in a state capitalist system if it's taking over a significant minority or halfway stakes in some of these big companies, and that is going to completely change the way in which the effect they have on the global economy. So I guess the question I've got is, looking at the UK economy, I'm not asking you to get your crystal ball out, because it'd be interesting to see how we respond to those kinds of interventions into the market, if indeed that's the way the US goes. But on the defence issue in particular, do you have any reflections on what might happen in the months to come? Because obviously we have had discussions around this table before about investment in defence in the wider sense, but that has normally come up as an issue that scheme members have with the nature of some investments and the global utilisation of the end product of those investments. I see it turning almost on its head in the next 6 months. It's become much more of a question about sovereign capability to sort of call it resilience, call it defend the country, and the question is whether, in terms of both reindustrialisation in some sectors, be that renewables or elsewhere, I foresee a bit of a push in that actually, and definitely looking at the ongoing conversations at UK government level about the amount of money going into the defence investment plan, I do see there being greater noise around where our money might be invested if we are returning to, if not a hot war world, but maybe back to a Cold War world in a way that we haven't had to think about it for the last 30, 40 months. Betty's desperate to come in first, Ethan, so I'll let Betty first, because she'll be jumping off the chair in a second, and then I'll come back to Ethan.
I've just done my slides on this for tomorrow. BlackRock, any of the big money managers have always had this sort of defence exclusion, controversial weapons, and this is somewhat in line with European SFDR, Article 6, 8, and 9. There's been a lot of push, finally, into Europe to sort of get rid of this or narrow it down. So it's gone from conventional weapons to prohibitive weapons, and they are things like landmines, cluster munitions, biological and chemical weapons. So basically anybody who produces those things. It's become a lot narrower. Interestingly enough, and this is what came out something out of the EU, nuclear weapons is not on it, which is interesting. And on reflection, I was thinking, if we now live in a world where you have Putin, where you have climate catastrophe, where you even have, like, you know, these sunspots which can kind of knock out all your, you know, radar and things like. We live in a world of, you know, species collapse, you know, habitat collapse and stuff. We live in a world of kind of just these catastrophes. In a funny way, you know, the whole idea of nuclear war seems like, we'll just add it to the list. Seems actually a little less shocking than, say, you know, climate change or something like that. I really hate to say it, but, you know, 20, 30 years ago, that's, you know, people were protesting in Germany against stationing, you know, Patriot rockets there. That seemed to be like the biggest threat. Now it's not the biggest threat, I think, and I think people have woken up to this. So anyway, I can send you my slides after I've done my thing tomorrow.
I'd be very interested in that, actually, if you could. Ethan, then we'll move on.
Yeah, thank you. It's a great question. And I think also what Betty mentioned about I haven't heard the energy security and maybe guns as an ESG kind of moniker, but I have also definitely heard as I mentioned, the super cycle around defence. Much of that, we've seen some staggering outperformance by the European defence stocks this year. A little bit subsided recently as AI took the mantle, but that has been at the back of the agenda. I'd say just a couple of UK investments, a couple of points. First of all, one of your neighbouring England-based funds, Avon, did a recent consultation with its members. They got 11% participation, which is quite high. And I did a podcast with Nick Dixon about it, around investing in aerospace and defence, particularly because these could have been areas that stakeholders might have taken ownership of in terms of the desire to have a divestment. Ultimately, the majority of those 11% voted in favour of staying invested, and then at an executive level, they decided to stay invested. So I think that reflects how much national security is now seen as an existential issue that is in line with sustainability, 100%. So I think that in terms of that has changed its shape as an area, and as Betty mentioned, there are a few exclusions, but I think it's increasingly becoming a more mainstream area to invest, particularly as we mentioned, it's likely that there will be continued investment there. As far as investment in the UK, I do think that the UK is perhaps realising late that it's de-risking. A strict kind of pensions oversight has led to an unintended consequence, which is an under-investment in UK equities and in the UK at the expense of an over-investment perhaps in gilts, etc., and less risky assets. That needs to be reversed, at least at the margin. And I would encourage you, at the earliest opportunity, to put some shape on your local investment policy and what that will look like, because that is what needs to be done across the LGPS without mandation, but just in terms of thinking about where your local investment takes shape. And that then I do see overtures around UK venture and small-scale growth investment in the UK in order to level up with the rest of the world as far as that's concerned.
Very quickly, Betty.
Yeah, just one also needs to acknowledge in this discussion that, you know, dual use is really, you know, because when you're talking about AI and all these things, you know, we've had Anthropic being in the, loggerheads with the U.S. government. You know, the majority of things that you can't basically easily say this is defense and this is conventional. So dual use, you know, drones. I mean, the same drone delivers your package for Amazon as, you know, it delivers, you know, whatever bombs. So it is all about dual use. And as even alluded to, a lot of the UK defence manufacturing or the component suppliers, they are small companies. They are venture capital. I did another private markets thing for Room 151 or whatever private markets recently, and there are a lot of, you know, smaller private capital, private equity firms and focusing on venture. That's where it is. It's not the listed companies, but it's the smaller firms. There is a huge impediment in the UK pension industry generally because there's a cap on, it is outside the LGPS, there's a cap on what defined contribution pensions can pay all for fees. And of course, you know, venture capital has a lot higher fees because it's smaller amounts, much heavier working. And so that cap is actually acting as an impediment to making investments in these really important sectors. So that's something that the Treasury regulator or whoever, pensions regulator, whoever it is, sets these caps, needs to address.
Excellent, that's fascinating. Definitely want to come back to this in the future. So, but not today. So, if everyone else is happy, John, if you're, yeah, fine. If I can bring members' attention to the recommendation, which is paragraph 11 on page 113. So the recommendation is that we note the investment performance that has taken place during Q1 in 2026. John, David, me, happy. Alfie's in the league, but we'll take that anyway. Agenda item 11, back to Joanne. This is elected member training on page 153.
Thank you, Chair. So members will be familiar with this report. As usual, the training log for 25-26 is available in Appendix 1. Also, Appendix 2, you will see that we provided an annual training programme for 26-27. This has got a list of suggested training events that are scheduled to take place during the forthcoming year. If you could consider this, and if there are any further training opportunities you would like to attend, then please let me know. You will notice that there is no WPP training on the plan. We are waiting for a plan for the forthcoming year, and I know members will be attending the WPP session after the meeting today, which will also go towards the training programme for this year. I just wanted to touch also on Lola, which is the LGPS Online Learning Academy that Hymans Robinson's provided us with. So on the 28th of May, they launched a new version 3, which incorporates a more blended LGPS learning plan designed to support a range of learning styles. So you've got shorter video-on-demand content, written material throughout each module, and interactive quiz elements. This, I think, is going to play a key role in helping Pension Board and Pensions Committee to meet the knowledge and understanding that's required in the new regulations.
Sorry about that.
So I would like to encourage you all to log on and complete some of the modules. What I plan to do also this year is direct members to different modules as we discuss different topics within Pensions Committee and Pension Board, asking you perhaps to take part in the training before one of the meetings, so to give you further information and background on topics that we'll be discussing. And then finally, I just wanted to mention that Hymans Robinson will also be launching a National Knowledge Assessment later this year. The fund has participated in this in previous years, and it's a good way of measuring Pension Board and Pensions Committee members' knowledge and experience in the LGPS. Once again, this is going to be more important than ever, especially with the Fit for the Future reforms. And there is a requirement for board and committee members to complete an annual assessment, which we do need to report to the pension regulator. So the Lola has been refreshed to take into consideration the new requirements. So I think working with Lola and the National Knowledge Assessment should provide members and board members with the relevant knowledge and experience to complete the National Knowledge Assessment going forward. So I'll provide more details on that when it comes available, but I think it's going to be around August, September time of this year, and we can discuss that in more detail nearer the time. Thank you.
Thank you very much, Joanne. We discussed this on Friday, and it'd be very interesting for those of us who did the training in our first year to see whether we have proportionately better scores as we're coming up to the 5th year of service on the committee. I'll leave that there. Okay, any questions, any comments on that item? I think Joanne is right with the, being serious now, with the regs coming in as part of the new legislation. I think MHCLG is going to be on looking at this in much greater detail than they have previously. So for the last 12 months of the life of this committee, and for those who are on the committee, if they come back onto this committee after next May, I think it's going to become much more important. Rightly so, more important, I think we need to consider. On that note, if members are happy with that item, the recommendation is on page 154. That's 6.1. It's recommended that the Pension Committee note the annual training programme included in Appendix 2 and consider whether any specific training areas or topics should be included. Are members happy to note the training plan? Excellent, fantastic, thank you very much. Item number 12 is the date of the next meeting. That is September already. That's the 22nd of September 2026. If members are happy to note that, this year is going by very, very quickly. Lewis has just told me we have to amend that. It clashes with the WPP JGC. Part of me thinks that this committee, the primacy of this committee, should make the JGC clash. We should get the JGC to change, although it's a bit like moving around a very, very slow tanker. Thank you, Lewis. We'll get back to you with the date. Just so people know, though, I've got Labour Party conference the following week, so...
We'll change that.
Well, that tanker might be in smithereens in the ocean by that point, so we'll wait and see where we are. Lewis is whispering at me again, but we'll do the whispering after the meeting's finished. Thank you, though. Agenda item 13 is exclusion of the press and public. So, to agree the exclusion of the press and public from the meeting as presentations and meeting papers are not for publication, because in accordance with paragraphs 4 of Part 4 of Schedule 12A of the Local Government Act 1972, as amended by the Access to Information Variation Order Wales of 2007, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the Council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweigh the public interest in disclosing the information. Are members content to close the meeting? Thank you very much. Jade, if you could turn everything off, please.
Could I ask members of the public currently tuned into the meeting to leave, please?
Forcibly eject, so we can't. Ta-da. There we go. That's an amazing power to have, isn't it? The forcible ejection button online. Is that all closed down now? In which case then, item number 14. These are the exempt minutes of the special meeting of the Pensions Committee on the 23rd of February 2026. Again, for members to raise any questions and to agree the minutes. Members, are we all happy with the minutes as presented? Yep. Happy? Any questions? No. In which case, I think we can take those as read. And therefore, thank you very much. That's the close of the meeting. So, as everyone knows, we've now got Rob Lamb and Jeff